All right, so if you're thinking about retirement potentially in the next 5 to 10 years, this video is for you. We're going to dive deep into the nuances of planning your RRSP prior to retirement and what you can do to set yourself up for success. So without further delay, Shaun, if I'm about to retire and I have an RRSP, what should my final contribution strategy be leading up to retirement?
Well, I think the general rule of thumb you hear out there is make sure you pound away at those contributions, maximize your contributions. You now have another 5 years, in some cases 10 years, if you're 50 and thinking about age 60 for retirement, but really pound away. Now, there's legitimate reasons for that, obviously. One is often we're at a higher marginal tax rate prior to retirement than when we move into retirement. So that tax deduction is worth a lot more for many of you as you're making contributions. But probably the most important part in this whole conversation is, do you have a plan? Do you know what level of contributions you need to make to be on track to achieving your retirement objectives? To me, that's the first question. And if you don't have a clear answer on that question, then you need to get some clarity. Now, whether you're a do-it-yourselfer and you've got your Excel spreadsheets, or whether you need to work with someone or hire an advisor, get it done. By the way, in the show notes, there's resources on retirement income planning. Make sure you grab those. There's no cost for them. And we have a second opinion service about the kind of retirement income planning we do. So get a plan in place or seek out someone who can give you that advice on the plan. So we've gone through that first step. You've done the planning and you know what level of contributions you need to make. For some of you, you need to keep pounding away at those contributions because it's now go time. You are trying to accumulate assets. You're going to retire soon. For others of you, when you do the analysis, you might in fact confirm that you're on track and don't need to save a lot more. And we often see that, Josh, when we do the analysis. Sometimes we see people have done a great job of accumulating assets for retirement. The problem is they're very top heavy in terms of registered assets. So when you look at their situation, they've done a great job of debt reduction. They've been making lots of contributions and staying ahead of the game in terms of their saving strategy. But as they transition into retirement, they don't have any non-registered money. They actually don't have a lot of TFSA value, and they're debt adverse. And so all that debt that they've paid down is not really there for them if they ever need it. I mean, it could be, right? But their psychological frame is they never want to use a line of credit or borrow money when they're retired. And they don't have a lot of TFSA value. So what's the punchline there? When you do a plan, you might confirm that you could actually forfeit some of those tax deductions because you're on track, and put a larger priority on your tax-free savings contribution strategy. And in fact, a lot of people can get away with that just because the compounding effect of those RSP contributions in, within 1 year to 5 years of retirement, not a huge effect. So if you begin to pivot away from P contributions and make TFSA contributions instead, to build up that tax-free capital as you transition to retirement for emergencies, buffer room, just in case unexpected expenses come up, that's something you want to be doing. But you have to get back to the core principle. The plan and forecasting will help to confirm which strategy is best for you. Maximize the RSPs, or a nuanced strategy where you take the pedal off RSP contributions and focus on debt reduction or tax-free savings account contributions.
Yeah, that's really good. The plan informs really everything. So along the same lines, as I'm looking towards retirement, there's obviously I have a certain risk tolerance prior to retirement with my investment choices, right? Does that change? Does my risk capacity change once I retire?
Well, at a certain level, it will for sure. I do find in the years that we've worked with many families, I think the natural default for people is to become risk adverse. The challenge there is that, most people will have another third of their life to live in their retirement years. So you don't want to be too conservative. But when I talk about portfolios for clients that are retiring, I just say one thing you need to keep in mind is you're going from an accumulation phase and you're still working to a deaccumulation phase where you're not working. And the buffer room that you have for contingencies and market volatility and down markets and bad economies, it's just not the same anymore, right? You're psychologically not quite as strong and flexible when you retire because, again, you don't have your regular income now using financial assets. And so that's a long way of saying you want to stratify your portfolio strategy. What we often say to clients is at least barbell your portfolio. On one end, you've got cash accounts or GICs or high yield savings accounts where you have enough money parked on the sidelines to fund 1, 2, or 3 years worth of income. And then the other part of your portfolio, the other end of the barbell, might be high quality growth assets. And then over the years, you're always balancing off between those two priorities. Again, it's the plan that will help to determine how much money needs to be in cash equivalents as that buffer, that safe harbor. Number two, how much in what accounts, in what dollar amounts, and if you're in a couple situation, in whose name is the money coming out. So the plan again informs that cash wedge or income wedge cash bucket strategy as you go into retirement. You don't have to become super conservative, but you do definitely need to think about deaccumulation and its impacts on your portfolio strategy.
Absolutely. All right. Second segment of this video. This is a really important conversation. My RRSP to RRIF conversion. You've talked about this countless times in other videos. What do people need to keep in mind when looking ahead?
Well, if you're retiring before the age of 72, so I think most people know that at age 71, they have to move all their RSP capital into a RRIF account. And then at age 72, they have to begin taking the RRIF minimum payments. Of course, most people are beginning to take money from their registered accounts long before that. So if you're retiring at age 60 or 62 or 65, the practical matter is you will be RRIFing some of your income. And the reason for that is you want regular monthly or quarterly payments. So the mechanics of how registered accounts work is that with an RSP account, you make contributions, but the RSP account's not really set up to be a systematic payment account. So the way you do that is you have to move money from your RSP to your RRIF account, and then you can set up monthly payments where money goes into your bank account every month. A piece of it can go to CRA automatically for you. And so again, your plan will help to inform what the effective tax rate is, and then you just remit that off every payment from your RRIF account. And what we normally say to clients who are retiring before the age of 65, let's say, or even the early 60s, don't RRIF all of your RSP accounts. Let's say that I've got a $600,000 RSP account, but I need $20,000 a year of income. Then what we'll say to clients often is take $60,000, put it into a RRIF account. You've got 3 years worth of income in that RRIF account, be in a cash wedge or GICs or cash flow GICs. And that money will come out and fund your income. Now, the reason for that is we often see clients go on contract, have employment income, other sources of income, where all of a sudden they don't want as much money coming from their registered accounts. So usually in the first few years, there's two accounts, the larger RSP account, smaller RRIF account, systematic payments. As time goes by, then generally we see people, and we recommend clients, begin to consolidate to one account. But in that transition period, they'll do that. The other reason is for those of you that don't have pension plans, don't have defined benefit pension plans, you need to find ways of creating the pension income tax credit. So at age 65, there's a $2,000 per year pension income tax credit, and you can create access to that credit by just annuitizing or taking some money from your RSP account, putting it into a RRIF account. I could put in, $14,000, $15,000, $16,000 into a RRIF account, start paying out $2,000 a year, and that income will qualify for the pension income tax credit, as an example.
Awesome. All right. So segment 3, tax efficient RRIF withdrawals. So what's the best order of withdrawals? How to avoid RRIF tax shock at my conversion date? And how does my spouse and I convert RRIF income efficiency? Do you want to just hammer away at those 3 questions?
Yeah. So again, this can get actually fairly complicated, and particularly in a couple situations. So often we'll talk to clients that will have non-registered assets, they'll have TFSA accounts, they'll have RSP accounts, and some clients will have corporate assets within a holding company. So they have all these different buckets, and each of those buckets have different tax consequences in terms of using them to generate cash flow income. So when we do a retirement income plan, what we're trying to do is to optimize the cash flow, for instance, in a couple situation between, the client and their spouse in terms of the drawdown of the accounts. And that'll basically tie into what we call the drawdown strategy, where often when we do a plan, taking out RRIF minimums on the accounts right away often makes sense. And then to supplement additional cash flow needs from their non-registered portfolio. And then the last account to be touched would be their tax-free savings account. So there's sort of a hierarchy of drawdown. Now, what we'll often do is we'll go through and look at different drawdown strategies for a client. So when we do a plan, we're going to do the drawdown strategy, look at the different sequences of drawdown. We'll also take a look at, one-off expenses. We often say to clients, granular on your expense allocations. What are your non-discretionary, your discretionary, but more specifically, your lump sum periodic expenses. And there you can see in the planning forecast the absolute critical importance of, okay, we're not going to fund that new vehicle purchase by taking a whole bunch of money out of the RRIF account. We're going to draw down on the TFSA, which they don't necessarily want to do, but they understand from a tax standpoint, it makes sense maybe to take the money from the TFSA and then maybe take some extra money out of their RRIF account to top off the TFSA. So you can look at the tax brackets, you can exploit the tax brackets based on the expenditure needs in the most tax efficient way. And of course, you do have a real important strategy around income splitting with spouses. So with basic pension plans for your employer, 50% of the pension income can be split with your spouse. If you don't have a pension plan, at age 65, the RRIF payments that you take out of your plan can be split. 50% of the RRIF payments can be split with your spouse. So that could justify fairly large RRIF withdrawals because you can split the income evenly with your partner and still have the income taxed at a moderate rate. When we look at planning for clients, when the pension income splitting rules came in place back in 2009, a lot of people thought that spousal RSP plans were now gone with the dodo bird, but that's not the case. So between age 60, if you retire, and let's say 65, there's no pension income splitting with RRIF payments until age 65. So the spousal RSP for your partner as a way of doing some income splitting can be a really useful strategy, at least for the first few years of retirement. And once you're 65, then registered assets like RSPs move to a RRIF can be split upwards of 50% of the income payment to your partner. So there's lots of nuance here. And I was just talking to some clients in BC this past week, and sometimes the strategies can be very counterintuitive in terms of what makes most sense. So the client had a question. He said, well, Shaun, why don't we take more money out of the RSP accounts and then push the money into the TFSA, and still we're trying to fund our income for retirement, because I don't like that deferred tax liability on the RSP RRIF accounts when I'm age 90. And I said, sure, we can do that. So we model it differently. And I said, we're going to withdraw more from the RRIF accounts. And that way, we're going to basically take the terminal tax liability in your RRIF account down to almost zero. Now, when we ran the numbers, the interesting thing was that was not the best strategy in terms of maximizing their monthly income through retirement. And I said to the client, sometimes these strategies are counterintuitive. Doing one thing to maximize your cash flow while you're alive can look different than trying to reduce the tax burden on your estate when you're dead, right? So it's a very important component to planning for retirement. What are your priorities? Maximizing cash flow or trying to reduce estate tax costs on death? We want to do both, but there's always sort of some compromises you're going to make in your strategy planning. For most of our clients, I'd say maximizing after-tax cash flow is the most important strategy for them. And that strategy can look a little bit different than I want to minimize the tax on my estate when I'm dead at age 90, as an example.
You mentioned this earlier, RSPs and government benefits. How do those kind of play together, and what are the implications of government benefits on my RSP strategy? And I'll just list some of the questions that we often get. So can RRIF income impact my old age security benefit? Should I delay CPP and OAS to optimize taxes? And should I begin RRIF withdrawals at age 60?
Yeah, like I think that for some clients, that RRIF payment, clients will accumulate assets unless you've got a good pension plan and non-registered assets, and your overall cash flow is good to the extent that you don't need money from your RSP accounts. So you're just defer the income payment until your 72nd year when you have to take income. And then in that year, you've got this balloon payment of extra income. And in some situations, you do see folks where their old age security benefit starts to get clawed back. Now, that's not a super common scenario, even though it's one of people's concerns out there. The reality is, you've got to be well into your $90,000 plus range of income as an individual before you're even worrying about clawback. But I would say that it gets back to that discussion we've already had. I mean, do you have a plan? Do you have a forecast? And so one of the things we'll do for clients is, we'll do the forecast and say, what if you don't need the RRIF payments, just defer it. And then it hits at age 72. Most accountants would say $1 deferred of tax is $1 gained. In general, I would agree with that. Absolutely. But there's times when it does make sense to begin triggering taxable income early. Make sure that you're not ballooning your income and getting a reduction of old age security benefits down the road. So you need a forecast, right? You need to look down the road and see whether that's an issue for you. And if it is an issue, then it may make sense to start deaccumulating out of your RRIF accounts early so you don't have a ballooning of income that begins to claw back some of your government benefits. So that's certainly one point that you need to keep in mind. The other thing is to play around with the numbers. Again, clients will ask us, should I take CPP at 60 or 65 or defer it? I'd say that a lot of people temperamentally, even if the numbers make sense to defer Canada Pension Plan, let's say at age 70, they may not do it because they're an N of one, right? They're going, listen, I get from a broad stroke standpoint, if I'm healthy at 60 or 65, I'm going to live past life expectancy, let's say mid 80s, and deferring CPP to age 70 probably is advantageous financially to me. But you know what? No one's giving me a guarantee about how long I'm going to live. I think I'm just going to take it earlier or no later than age 65, right? That's the basic, I think, gut feel for a lot of people. Where it changes often, I find, is if we go, well, let's take a look at a retirement forecast where we are pushing back your government benefits and not having an income coming right away and creating basically a tax window. So we've reduced your taxable income and we're actually taking out more from your RRIF accounts or your registered money, let's say between 60 or 65 and 70. So we're deaccumulating, we're taking out probably more money than what you need from a spending standpoint, paying tax at a moderate rate, and then you're going to get your government benefits down the road. But we use that tax window, reducing your income because you're not getting the government benefits, to exploit the tax brackets. And in many situations, it actually makes a big difference in terms of long-term numbers. So again, we keep coming back to this idea that the plan's important. You just don't want to be a gunslinger, right? You're just kind of shooting from the hip and hoping things are going to work well, or you're using gut feel, or it drives me crazy when YouTube videos talk about rules of thumb. Sometimes we talk about rules of thumb, but that's the stupidest thing in the world, really, because there's great software out there and forecasting tools. So it doesn't have to be a shoot from the hip kind of exercise. Get the planning done, and then you know precisely what is right for your circumstances as you try to balance off the numbers with your psychological, definition. Like some people are more dour about their life expectancy. So if the number's not hugely beneficial to them to defer benefits, like say CPP, they might take it early. But they make that decision in the context of the plan and see what the difference is in terms of the financial values.
That's so, so good. And if you're watching this, you're like, how do I model that? Don't be afraid to go to our website. We can review how we might be able to help you. If you have any questions, make sure you comment them down below. We'd love to answer them in future videos. Thanks for watching. Take care.